One of the questions that I like to ask CEOs, in part because it promotes accountability, but also because it's fun, maybe more fun for me and more fun for the audience than it is for you, Steve, or you, Jean, is to ask CIOs what you got right and what you got wrong.
We're very good at the first one. Okay.
So it goes without saying that this is a year that has already, right, been full of surprises, and we're not even halfway through yet. So being in the prediction business is never easy, perhaps harder still in 2025. I admire your bravery. Jean, let's begin with you. When you look in the mirror and you say to yourself, gosh, you're a clever girl, Jean, or you say to yourself, oh, Jean, you need to do better, what are you talking to yourself about?
Well, the great thing is I hedge myself most of the time. Being an economist by training, it's on the one hand, on the other hand. So what I got right or what we got wrong. Let's go with the wrong, because I think a lot of us will blush at the same time, is US exceptionalism. So I kid you not, Outlook 2025, high hopes that US exceptionalism will prevail. And Trump has made a lot of election promises that we believed would come through. Lo and behold, reality check, that was a rude shock come Inauguration Day, Liberation Day. And we all know that story. What we got right, however, is that we always believed in diversification. So we've actually upgraded Asia ex-Japan as early as Q3 of last year with a preference for Hong Kong, China. Probably in the short run, we would have been wrong, and there was a lot of skepticism. But that's the beauty of asset allocation, that's the beauty of diversification, is that if you have patience, you are ultimately proven right. And this year it's been a great trade on two fronts, which I shall discuss, which is really the benefits of diversification, but also the fact that the currencies have worked in our favor. So that certainly is, I say, the one hand and the other.
Steve, what about you?
So I think in terms of what we got right, I think we'll find out whether we got one part right, which was our view was that equities would go up point to point through this year, and obviously so far that's true, but obviously we're a long way from the end of the year. And we said, but it wouldn't be a smooth ride, so we were talking about a 15 to 20% drawdown at some point in global equity markets. And obviously, at least as far as US equity markets, that's exactly what we saw. And then we'd say,
in April, yes.
Yeah, we'd get the Trump put coming in. Now, we were right for the wrong reasons, because I think it was probably the Treasury sell-off that actually prompted the recalibration of trade policies, to put it politely. But we did see that pull back, and then obviously now we've gone to the races again. Actually, I think that's the key. I think and a similar point actually to Jean's in terms of what we got wrong. I don't think we didn't see the dollar weakening to the extent that we've seen it now. In the big picture, we are back to about the middle of the 5-year range. So that's not. I think there's a lot of over-dramatization about the dollar weakness, and I'm sure we'll talk a bit about the outlook here. So yes, we've seen a 10% drawdown in the dollar on a broad-based basis, but really we're just at the bottom of the range. So we haven't really broken out yet. But that clearly we weren't looking for a 10% down move in the dollar this year. So it's interesting where we go from here.
Each of you has to process in the, as you figure out effectively what positions and allocation to recommend, an enormous number of variables. Of all those variables, right, that are going to have an impact on the outlook for global assets, which ones stand out to you right now as the most important, Steve?
I think it's not really a variable. Maybe we can look at it in one way where it is, but it's really to the extent that what's happened this year is a permanent shift higher in uncertainty and leads to a permanent recalibration or a semi-permanent recalibration of business intentions. So we've talked to obviously a lot of entrepreneurs, small business owners, and the key thing immediately after the Liberation Day was, what should I do? And the reality is you should probably sit on your hands and see how this is going to play out. And just everybody doing that around the world leads to economic impact.
Sure.
So the question is, to what extent does that lead to the genie being out of the bottle? And therefore, regardless of trade deals being done, etc., we could still go into recession. And the other way to look at this is the soft data, hard data gap has obviously been widening. If you look at economic expectations, the economic surprises index, the soft data is underperforming massively and the hard data is outperforming massively. That's going to narrow. Which way is it going to narrow? And I think that's the biggest question that we've got to try and figure out as, obviously, if you're an economist, but also obviously as investors as well.
I think that's a very interesting concept, sort of structural uncertainty in a way. What about you, Jean?
So that's where we agree on structural uncertainty. The cause of it, however, I believe that we're actually in the midst of a very seismic shift in terms of the correlations as well as the decorrelations of the variables that we're used to is breaking down. For example, yields and the dollar, right? That used to be a correlation, but that's broken down because there's something underlying that's shifting in terms of calibration of risk. So I think that whole notion of DM versus EM and how we have invested in the past and our attitude towards fixed income portfolios, for instance. So that whole uncertainty means that we have to actually change the way we act. So quite the reverse from being shell-shocked. Our mammalian, as mammals, our response to an attack typically is you either freeze, fight, or you fly, right? I think as human beings and very sentient ones in the room, we actually have to strategize. And so as a bank and as an investment team, what we've done is say that what is the strategic shift we need to do as investors? And so we looked at our strategic asset allocation framework and say to ourselves that if all these variables are breaking down, that forecasting ability goes down. Are we going to change the way we allocate assets? So we've gone through a whole robust optimization model, quite a lot of data involved, historical and also forward-looking, to recalibrate how investors should think about their portfolios. And I think the deep work we should be doing as individuals as well as investors is to say to ourselves, with all of that changing, the blocks breaking down, countries having different relationships from each other than we were used to post-Cold War, what does that do for our investment forecasts?
I want to pick up on something that Jean said, actually, in terms of the correlation. You talked about dollar and yields, but actually, if you look at it in the recent past, the dollars actually look like a risk-on vehicle, right? So if risk is doing well, the dollar's stabilizing. If risk is off, which I think is probably the opposite of what people thought. Again, coming back to what we got wrong, you go, okay, risk off, dollar does well, right? The dollar smile, the infamous dollar smile, right? So I think that's the challenge. So obviously a lot of people worried about how far the dollar could go. Actually, our view is that the market is massively underweight the dollar and US assets. So we could still see in the short term a melt up or climbing the wall of worry for US assets until that positioning corrects itself. But then longer term, you say, okay, is the dollar going to crack? Certainly Trump wants it to crack, right? That's one of his policy objectives. He doesn't want the treasury market to crack. So there's a bit of a trade-off there for what they're trying to achieve. But if you're saying, okay, if I need to hedge against long-term dollar weakness, let's say I take a view that the dollar's going to weaken another 10% over the next 12 months, then what do? And actually, you invest. Now, most people, their reaction has been, oh, short duration, hunker down, this freeze or aspect. And actually, if you're worried about dollar weakness, you should be invested because dollar weakness is very good for assets generally, both equities and bonds historically, assuming this short-term positive correlation with risk doesn't continue. And so that is usually a great way to hedge against dollar weakness. And that includes US assets, not just EM, although obviously in that environment, historically, non-US generally outperforms the US assets over the longer term.
Perhaps I'll share a little bit of what that conversation is with wealth clients. And that's actually resonated with a lot of clients. Previously, we were preaching the message of diversification, and it was always, but my dollar assets are doing so well. The US market has returned, exceptionally for the past few years. Why should I change? Increasingly, this now lands better for wealth clients. And here in the region, I mean, typically, the typical wealth management client in Asia has a home currency. It's a Thai baht, IDR, Chinese yuan. Then all their global investments, call it the US bucket, is in US dollar denomination. So we're now postulating to clients, it is not a binary decision, dollar weakness versus my home currency strength, but it's what is that third currency? If that third currency is the euro, is it the yen, is it the Sing dollar, for which we think that there's great stability in the Sing dollar because it's structurally managed against a band of currencies in this region. So it offers that balancing act between the dollar linked currencies as well as your home currency and that third currency. I think that has actually helped us to frame the discussion into a more diversified one rather than a binary decision, is it going to be structural dollar weakness, etc. Yes, but it may not pan out in the short term, but certainly in the long run, a more diversified basket of currencies, because economies are evolving that way, could be a profitable one for the longer run.
Sorry, Eric, I don't want to make you surplus to requirements, but I just want to respond quickly. So I think, look, we get that the dollar is being undermined by policy uncertainty, right? So I think we all understand that. The question is, okay, so, and that's leading to marginal changes. So that, just to be clear, the European versus US trade, okay, Europe has outperformed significantly this year, but it's still in a long-term downtrend, right, over the course of the past decade. But I think what everybody is sort of saying is, okay, I understand that the US is weaker in some sense in terms of policy certainty, but to what extent are other people picking up the baton from the US? And I think that's where people are struggling and saying, yes, okay, you've got German fiscal stimulus,
it's early days,
etc. You've got what China's been doing to sort of try and support the economy, etc. But it's just, it doesn't feel like there's an obvious person to take over.
One of the things, and you've both touched on this, but I'd like to go a little further. One of the things I'm particularly interested in understanding is how your clients are processing, if you will, what the Trump administration has been doing for the past 5 months. And there's a lot going on, right? You have, obviously, tariffs and Liberation Day and the threat of inflation, but also the threat of stagnation. You've got encroachment on monetary policy from the Oval Office. You have the big, beautiful bill and maybe an additional $2.4 trillion of deficits. You have the weaponization of the Justice Department, right? The potential withdrawal of the US from global security alliances. I could go on. How are people thinking about this? Do they see this as being a structural change in US policy? In other words, henceforth, the United States is a different place, and we need to think about it differently as investors.
So I think the starting point for me is, look, everybody realizes that the US is still very important from an investment perspective, right? So, but I think what we're seeing more and more now is that clients, yes, they did a knee-jerk going short duration, etc. But I think the people that take the portfolio approach that Jean was talking about at the start, they're seeing the benefits of that coming through. So if you look at, our balance strategy is up 5 to 6% this year. And if you told me at the beginning of the year what was going to happen on the fundamental side, and then said, what will your balanced portfolio do? You probably wouldn't think it's going to be up. You probably think it's going to be down. So I think that's where people are sort of saying, actually now they see the benefits of that sort of diversified approach, and that is becoming a much more core part of their portfolios.
I think for us, let's talk about the positives first. If you look at the Trump administration and the tariffs, right? Tariffs are as old as the hills, as early as 1776. Adam Smith didn't write Wealth of Nations for nothing. It was really about trade, and there was protectionism at that time of wool mills in the UK, or coal mines, etc. So that whole narrative about trade, it is not zero-sum. At the end of the day, we all know that by trade, we actually create a bigger pie as a globe, And there are coincident and intended and unintended benefits as well as downside of global trade. So that's that reckoning, moment of reckoning. And I think, that whole adage of, Trump always chickens out, which was coined by the FT, it's a neat meme, but what it really brings us back to is pragmatism. We have faith that governments, companies, countries are pragmatic at the end of the day. So case in point is, of course, the conversation or the negotiations overnight in London between the two, between US and China. And that's just a recognition that let's get real, guys, right? Let's be pragmatic about the whole thing and see where those trade-offs to. So I think that tariff tussle, if you like, is more a means to an end rather as an end to itself. So that gives us some hope and optimism that ultimately that prevails. What, however, has changed is the erratic nature of policy shifts and that erosion of faith in the US sort of policy-making apparatus, let's call it. Because I think traditionally we have expected things not to happen overnight. For instance, we had time. We know when the FOMC meets. We know when the next Senate hearing will be, etc. So that level of predictability now makes it calls to question whether, as a developed market versus an emerging market, should we look at them on level playing field? So Asia, for example, emerging Asia, are they actually on level playing field where we need to calibrate the risk reward and factor in the uncertainty just as much as any other market? And the US, just because it's the largest and the DM, doesn't give it a free pass in terms of our reckoning of the risk reward.
I want to hear from you in a moment, Steve, but since Jean brought it up, and it is so topical, are you both believers in the taco trade? Does Trump always chicken out?
I think he is a pragmatic person, and you can see that on various fronts.
Very well put.
Pragmatic. What do you think?
I think...
So yes?
If it's in the US favor, yes.
I think the key is pressure has to be brought to bear, and I think China played the card of the rare earths very well, right? I think Europe, I'm sure that Trump hates the taco label, so he will look for opportunities to prove that it's not there, and I hope Europe finds its rare earths, because otherwise things could get messy again for a while. That's probably where I'm a little bit concerned.
We've heard a lot already today about U.S. exceptionalism, and this notion of U.S. exceptionalism, or the argument in favor of U.S. exceptionalism, is based on the belief, right, that America's historic commitment to democracy and to liberty and to free markets sets it apart from all the other economies out there. And in finance, and Steve, you've actually put this in some of your writing, it's translated into consistent outperformance for more than 30 years by U.S. equities and, of course, the U.S. dollar as well. It feels, and you've both touched on this, that we're in a different place right now. Do international investors, the ones you were talking about, Jean, the ones who are naturally long, whatever, Thai baht, ringgit, whatever the case may be, do they need to recalibrate the risk premium that they attach to U.S. assets?
I believe so. So I think that is exactly what's happening at this point, where we're seeing perhaps at the margin, and this is happening in investment committees as much as in individual investors' conversations with us, is the need to prepare for a period of uncertainty. How do you hedge yourselves? So gold was mentioned as well. That's one of the asset classes that we favor, as well as uncorrelated markets like private markets to some extent. But each segment or sub-asset class needs to be calibrated according to the new regime of uncertainty. I think that's very core to our belief in terms of what has changed from last to this year and henceforth. So I think that's really important for any investor right now to just be cognizant of that. Yeah.
I think that there's two things that I would sort of put out there as questions rather than giving answers, right? So I think the first thing is, in the US, does Trump get constrained at some point, either by his own party, by the Democrats, or by the midterms, or the courts even, right? We've had that thrown out there. So, and to what extent would that then reduce the risk premium in terms of policy uncertainty? I think that's one question that we still, it's very easy to focus in the here and now and on the Truth Social, are they tweets? I don't know what they're called, but on those, that policy-making vehicle that we have, there is Truth Social. The second thing is, everybody's very focused on AI and tech and communication services as being a key driver. And the US clearly has a lead in that space. So from that perspective, you're like saying, okay, how are other countries going to sort of fill that void? And obviously the DeepSeek moment in China was a very significant event. You almost need to see something in Europe as well. And those are the two questions I sort of say, okay, I think I share the sort of sentiment saying, yeah, it makes sense for this long-term US outperformance to come to an end. But then you look at those two factors and you might go, it's probably just too early to call it today.
I think I'd like to maybe differ from Steve on that point. I think, again, history is no guide of the future in innovation as well. And what's a little bit troubling, of course, is the attitude towards skilled immigration and skilled immigrants in the US, case in point, the Ivy League colleges, et cetera. And does that mean that if all else equal, a brainy person anywhere in the world no longer thinks that there's only one magnet where they can operate at their most optimized level? And actually, there are many countries in the middle, whether it's Europe, Middle East, Canada, or Asia, right? Hong Kong, China, Singapore, and even the ASEAN countries. Is it now a world where actually there is equal opportunity, or maybe a much more balanced opportunity that innovation could come from somewhere else? And there could be different languages and different types of data analytics from the AI sort of technology development that becomes efficacious for everyone as well. So to that extent, I think we cannot assume that innovation will only come from the US going forward. It's a healthy thing for the world. So we tend to think of things in longer term horizons, 5 to 10 years, as what we call super trends, which are structural. It involves demographics as well as economic growth, and also the I like to call geopolitics / geoeconomics, because I think geopolitics is no longer just a political discussion. It's begun to weave into our economic forecast as well. So I think those structural trends are going to guide investors in terms of a slightly longer term horizon.
I want to finish by asking you both a yes/no question. You're
They're
going to hate me for it
things.
because it's not an easy one to answer yes/no. Yes or no, should investors still think of US Treasuries as risk-free assets?
No.
No.
There you have it, ladies and gentlemen. Steve Brice, Jean Chia.